Hey everyone,
Designing,
and today we are going to talk
manufacturing,
about
and
two
marketing
interesting companies
powered
that are quietly making big moves in their industries. So the first one is an industrial electronics company
Rise with
that just
confidence.
delivered strong
Designing,
Q1 revenue jumped
manufacturing, and
58.5%
marketing
and
powered
profit surged 85.5%. And the second company is an auto parts maker that's hitting new highs in profitability. It just reported record margins of 13.8%. So basically, both the companies are expanding steadily. One is scaling up through large infra orders and new verticals, and the other one through high margin innovation in the automotive sector. So, welcome to another episode of Noisemaker, where we keep things simple and talk about companies that may not always come in the spotlight, but they have a really strong growth potential. I'm Saizal Agarwal, Equity Research Analyst at Desvelado Advisory, and today we'll be talking about two companies that are making solid progress in their business, and if current trends continue, they might continue to grow even further. But before that, let's have a quick look at the disclaimer. So, any discussion, facts, or writings provided here are for informational purposes only and do not constitute any buy or sell recommendation. So, please conduct your own due diligence before making any investment decision. Now, let's move to the first company, Hind Rectifiers Ltd, which manufacture power electronic equipment like rectifier, converter, and wide range of railway components, from transformers and motors to control panels, battery chargers, and even pantry units used in trains. Now, Q1 FY26 has been strong one for them. Revenue grew 58.5% and net profit surged 85.5%. And this was mainly driven by continued traction in railway segment, where they bagged 327 crores worth of new order from Indian Railways. Operational efficiency also improved, all thanks to better product mix and tight cost control. EBITDA rose 66.9% year on year and margins expanded by 60 basis points. Just commissioned their new propulsion system, which could further support growth in coming quarters. But beyond railways, they have also started export to Europe and entered into partnership with HAL and DRDO. So now Nishant would be joining in for more information. So Nishant, do you think that this signals a meaningful diversification strategy, or is it too early to say?
Yeah, I think it's a good question. I think it does signal a shift, even if it's in the early stages. Anti Europe and defense through HAL and DRDO shows they are thinking long term. They are building credibility outside their core railway segment, which is smart, especially if railway capex slows down in the future. Also, they are not just betting on volumes. They have announced a 30% revenue growth guidance for FY26, which is backed by their strong order pipeline. More importantly, they are focusing on backward integration, meaning they are trying to manufacture more of their inputs in house that could boost margins and reduce dependency on external vendors. But let's take a step back. If we look at FY25 as a whole, revenue grew 26.6% year on year. EBITDA margins on the other end improved to 10.7%, and net profit tripled to rupees 37.1 crore. They have shown steady growth across quarters. Q4 FY25 revenue was rupees 185 crore and Q1 FY26 rose to rupees 214.8 crore. That shows momentum is building. So I think, Cecil, do you think their shift from being a part supplier to a full system provider could be a real game changer?
Absolutely, Nishant. There is where things get interesting because Hind Rectifiers is slowly evolving from a vendor supplying parts to becoming a system level player, meaning that now they can offer end to end solutions, and this not only increases wallet share per locomotive but also strengthens client stickiness. And this approach fits perfectly with government tailwinds as well, like the 45,500 crores rolling stock budget and Atmanirbhar Bharat push for localized manufacturing. If they can deliver integrated solution domestically, they could become the go to vendor for larger long duration projects. And they're also making changes at the operational level, digitizing workflows, integrating tech driven planning, focusing on high margin bids. And this isn't just cost controlling or cutting, it's about building a more resilient and agile business that can handle raw material fluctuations and uneven order inflows. But here is what I am wondering, with all this in play, Nishant, do you think that they are well positioned to deliver consistent earnings and avoid the cyclicity we often see in the capital goods player?
Yeah, I think that's the key, consistency. And yes, I think they are setting themselves up well for that. by being selective with orders, investing in tech and integration, and focusing on margin accretive segment. They are reducing the typical lumpiness we see in this space. They are not just chasing every tender. They are targeting profitable long-term projects, and with exports, defense, and propulsion systems in place, they have opened up multiple revenue levers. So to sum up, Hind Rectifiers is moving in the right direction. Strong railway order book and execution, expansion into high value systems, early diversification into defense and exports, operational shift that could smooth out earnings volatility. And if they stay focused and continue executing like this, they could move up the value chain and become a more profitable, high margin player in this infra linked space.
Okay, thank you, Nishant. So now let's move to the second company, which is ASK Automotive Ltd, a key supplier of advanced braking system for two-wheeler. In Q1 FY26 was strong for the company, where revenue grew 11.1% year-on-year. EBITDA rose 19.3%, with margins hitting an all-time high of 13.8%. And this was mainly due to improved product mix. They exited the lower margin wheel assembly business and focused more on high-value products like ALPs and ABS. Also, their Karoli and Bangalore plants, they saw better utilization. But Nishant, there seems to be a deeper shift happening in their business model, right?
Yeah, exactly. What Ask is doing right now is more than just cost cutting. It's a clear repositioning. They are leaning into power train agnostic, EV ready component, which is smart because it's future proof. Their portfolio and they focus on lightweight and medium solutions and high performance braking systems aligns perfectly with the EV trend. Their AISIN joint venture is another strategic lever. By tapping into the aftermarket, which typically has higher margins and recurring demand, Ask is broadening its revenue base beyond just OEMs. Even capacity utilization tells a story as production ramps up at Karoli and Bangalore. They are getting operating leverage. That's how they manage the 80 BPS basis points margin that seems uh, bumper this quarter. And they have guided for 13 to 15% revenue growth this year also, with margins around 14%. And given their product shift, that seems realistic.
And if we look at FY25 as a whole, the number support that trend. Revenue grew 20.2% year on year. Net profit rose from 173 crores to 247 crores. So clearly margins are stabilizing. But Nishan, what's the game plan ahead, especially with this alloy wheels entry?
Yeah, I think that's the interesting part. They are entering the rupees 2000 crore alloy wheel market, targeting high pressured die cast wheels via partnership with LIUHIO and Yangawa. Testing has begun and production is expected in H2 FY26. This could be a game changer, not just from a revenue standpoint, but also because it pushes them into the premium two wheeler space, which is less price sensitive and more brand driven. And don't forget the Karoli plant. It's currently at 50% utilization, but AS believes it can eventually generate approximately 1100 to 1200 crore in revenue as volumes scale. Per unit cost will fall, boosting margins further. What I like is that they are not just expanding blindly; they are scaling with their strength and with targeted capex and clear margin focus.
So Nishant, with all this higher margin products, aftermarket expansion, alloy wheels, and plant ramp up, do you think that AS can deliver steady, high quality growth without falling into the margin growth trade off trap?
Yeah, I think that's the big question. I would say they are on the right path. Ask is showing that it's possible to grow without sacrificing profitability. Why? Because they have exited commoditized segments. They are entering segments with pricing power. Their cost discipline has held up across sectors, and they have built long-term customer relationships. They are also emerging as a premium margin creative supplier with growing relevance in both ICE and EV ecosystem. So yes, they're not just growing, but they are upgrading the quality of their growth, and that's what makes this story worth tracking.
Okay, thank you, Nishant. So that really helped us understand the direction both these companies are moving in. Now let's take a quick look at how some of our previous picks have performed. So first is Nova Agritech Limited. We picked this up at 49.5. Now it's at 59.3, giving a return of 19.8%. GMM Pfaudler Limited from 1,271.4 to 1,281, and that's a gain of around 0.8%. Then we have Oriana Power Limited. It moved from 2,190 rupees to 2,200, delivering a modest 0.5% return. Paras Defense and Space Technologies Limited. This one saw a dip from 818.9 rupees to 678.1, which is a minus 17.2% decline. And lastly, we have Gabriel India Limited. We picked this up at 842 rupees and it's now at 1034, giving a return of 22.8%. So overall, a pretty good mix of gains, and we'll continue to monitor all these companies closely to see how they shape up in the coming quarters. And here is the QR through which you can access all these previous picks which we covered recently. Now let's move to the summary of today's company which we included in today's Noisemaker.
Designing,
Hind Rectifiers
manufacturing,
Limited, the company
and
has
marketing
reported strong
power
Q1
semiconductors.
FY26 result with 58.5% year-on-year rise in revenue to 214.8 crores
manufacturing,
and 85.5%
rise with
year-on-year
confidence.
growth in net profit.
Even designing,
ASP
manufacturing,
Automotive, the
and
company has
marketing
delivered strong
power
Q1
semiconductors.
FY26
Engineered for
performance,
India.
reporting 11.1% year-on-year
Rise with
revenue growth,
confidence.
19.3%
Designing,
year-on-year
manufacturing,
and
and
record
marketing
margin of
power
30.8%.
semiconductors. Engineered for India.
So that's it for today's edition of Noisemaker, and if you found this breakout informative, you can scan the QR code to read the full report, and we'll be back soon with more simple and clear market updates. Until then, stay curious, stay ahead and stay informed.